Okay, welcome folks. This is another video tutorial for the Gamma Optimizer room, and in fact for everyone is a public tutorial about options, in particular about butterflies. So we are going to talk about advanced topics trading butterflies. The reason I am doing this is because there is plenty of literature about butterflies out there in the internet, but it's very unhelpful when you want to do trades in real life. No, so let's dig into this. I hope you are listening to it. I guess I did a sound check and it works fine. So let's start right away, and then other people will join eventually. So let's look at the outline of a butterfly trade. Now, for those of you that really don't know what it is, so a butterfly trade is just a complex trade. It's a trade that involves buying and selling different options simultaneously. Now, it's one of those really common things that you will see for advanced players doing. So just to understand the lingo a little bit, I'm going to explain the parts of a butterfly. A butterfly trade has two components. The first component is a body, and the body is just the central strike. So a butterfly has a strike at the center of it, and that's what we call the body. And it also has two wings, and the wings are just strikes that are usually at the same distance from the center. One is upwind of the wing, and the other one is downwind of the wing. So like the example I have here, I have a butterfly for SPX that the body is the 2550 put, that's the body of the fly, and the wings are the 2530 and 2570 put. And as you can see, they are at the same distance from the body. They are just 20 points away from the body. So that's a butterfly for you, no? And this is the notation that I use on my room. I use this notation where I specify every leg individually. But in real life, you don't do this. No, you are not buying and selling these things individually. You are doing a single trade that has the butterfly, and all of the brokerage houses, every broker knows how to execute a butterfly trade. So this is it. This is a butterfly, and some of you might have already seen it. Some of you already know how they work. But let's look at this. Let's look at let's start dissecting what the butterfly can do for us, and what kind of things we can extract from it. So the first thing we want to figure out, okay, I have this really complex trade, really cool complex trade, but how much money I'm going to make? I mean, this is one of the things that we want to be able to compute. We want to be able to compute the max payout of a trade. Well, so in the case of butterflies, I call it a naive payout because you will never get it. The odds of getting the max payout of a butterfly mathematically are zero. It is a little counterintuitive, but it's the truth. I mean, if you really go to the statistics, it's impossible that you will get a perfect pin on that particular strike, or at least it's very hard to quantify the odds of having them. So in most of textbooks from statistics, they tell you that the exact probability of hitting a particular value is always zero. But in general, the region, you want this thing to be as close as possible to the body, and then you get the max payout. The max payout is the easiest thing to compute in the universe. You don't need any advanced mathematics. So basically the max payout is the width of the fly minus the cost. So in the previous case is 20 minus the cost, and that fly is probably priced less than $2. It's probably 1.5. So the max payout is fantastic. It's 20 minus 1.5 is like 18.5. We're talking about like serious risk reward, but remember, it is almost impossible to see it. So it's a very naive way of computing it, but it gives you an idea. It gives you an idea what the trade is going to give you. The other thing that is impossible is that to get is because you have to hold the fly until it expires, and that's very difficult to do. I mean, butterflies are one of those positions that you will not want to hold until expiration, and we'll see later why. So that's how you compute the max payout of a butterfly. Let's compute a more realistic payout and try to guess the profile of the profit and loss chart. So again, the realistic payout of a butterfly is also very simple. Doesn't require any advanced mathematics. So you just take the max payout you computed previously, and then you subtract this difference, the absolute value of the body minus the underlying level at expiration. So in this case, for instance, imagine that for some reason in the previous butterfly, XPX settles at 2,560 on December 29th. So the fly, this is the way the fly pays. The fly pays the max payout minus this difference. The difference is 10 points. So it's a very nice payout too. It's $10 minus the cost. And if the cost is 1.5, then the payout is going to be 8.5. So this is a very fantastic payout. It's almost 6 times the cost. So you can see butterflies seem to be really good, in particular if at expiration, look at this formula, the profit and loss is if this difference is small. So here is giving you a hint that the butterfly is one of those trades that will provide you with really nice profits if at expiration the underlying that you're trading finishes as close as possible to the body. In particular, if it's exactly at the level of the body, this difference is 0 and you get the max payout. But we already discussed that that is really almost impossible to get. But I mean, it's a decent. And from this formula, it's easy to compute break-even points too. So let's look at the break-even points of the butterfly. Again, you don't need any advanced math. The butterfly, the break-even points is just take the body and just add and subtract the max payout. You have 2 break-even points. The butterfly is very peculiar. It's a position that will break even at 2 different levels. So in the case of this fly, I have a short example there, is we have a cost of $2. So the max payout is 18 and the break-even points are very easy to compute. I just add 18 to the body. So the butterfly will break even if XPX is at 2,568 on expiration, and it will also break even if the butterfly is at 2,532. So right there, you are seeing that the butterflies are a very interesting trade because first you have 2 break-even points. So that means that between this level, between 2,532 and 2,568, you are making money. That's what it means, no? It means that in that range, if XPX finishes in that range, you're actually making money. So right there is giving you an idea of when to use a butterfly, or for what kind of trades you want to use a butterfly. Right there, and it's very easy to compute. Now these formulas are very handy. You should be able to do it in your head, not at some point if you're trading lots of butterflies. So as I mentioned, as you can see from that equation of profit and loss and the break-even points, then you know that a butterfly is a great way to express a thesis when you expect the underlying to be at some point in the future, to be very close to the body. So that's your expectation. If you have like a number in your mind, you think that GDX will go to a certain value, or you think that any underlying will be kind of hang around a value in a month, then a butterfly is one of those things that will work really well because it's a bet on how close it gets to it. And it's a bet that can pay off massively if you are correct. So right there, I start thinking about it. So I kind of enumerate 2 cases. The first case is the easiest one. Let's pick a body that is near the money. So I'm picking the body of the fly right at the level where the underlying is trading right now. If you do that, then the bet that you're making is that that underlying is not going to do anything during the duration of your butterfly. So that's what is called a range-bound trade. You are basically trading range-bound. It doesn't matter if it goes up or down. You're making money as long as it doesn't deviate that much from the body, which is at the current level. That's one way of trading, I guess. If that's your thesis, no? If you have a thesis that calls for like the underlying going nowhere, like for instance GDX, that it has been there for such a long time in a certain region, butterflies could have been the perfect trade for the last month, I guess. And another way of trading butterflies is, okay, then let's pick the body really far away from the current at the money level. And so in this case, now the bet becomes the one that I described earlier, is a bet that somehow the underlying will move towards your target, and then it will kind of stick around there. So if you think about it, that kind of behavior is usually the behavior that you see when when a particular symbol is in a topping process, like say is moving towards a top and it kind of oscillates in the top before starting to come back down again. So you have a great topping thesis, then a butterfly is a way to play, or the same with bottoms. You think the underlying will go down, but then it kind of will stay around the resistance area a little bit. Then there's another good way also to play butterflies. So the thing is, this is all very nice, and the equations for profit and loss and break-even points are really nice and really simple to compute. But realistically, no one, and I mean no one, holds a butterfly until expiration. And I have a question. Oh, wow, look at that. So I have been holding a KSU butterfly for almost 8 months. So this person, so yes, you are brave, my friend, holding a butterfly for so long. I hope it's making really nice profits there. And the idea with butterflies, yes, butterflies, you will see later on that time benefits butterflies a lot. And the longer you can hold them, the better. But I'm telling you that realistically, it's very hard to hold the butterfly until expiration. In fact, this is something that I want to put inside your minds and so have you consider this. Is crazy. It's like short of crazy to hold a butterfly that has 1 week or less on it. So, for instance, the butterfly you have been holding for 8 months, no? If you hold that butterfly for the last week of expirations, that is gonna be probably the hardest week of the whole period, because in the last week, I'm going to get ahead a little bit on the subject here. In the last week, gamma for that butterfly is gigantic, and you are short gamma. So what that means is that any little movements, very little movements in the underlying, it could be just a few fractions of a percentage up or down, can change the butterfly dramatically. So you are making tons of money on the butterfly, and the thing just move a little bit, and then all the profits disappear or get reduced in half. So no one wants to do that, and no one seriously in real life holds butterflies that have so much gamma exposure to it. So the idea is then, okay, we are not holding this until expiration, so then what? Then how can we use this? If we are not going to hold this until it expires, how can we extract money from this, and how we can model this realistically? So before going into reality before expectation, I want just to get something off my chest. This is one of my pet peeves, and it's a minor digression here. But something I cannot really stand when I see references to strategies that provide income. In particular, option strategies that provide income. So there is no such thing as an income strategies with equities or equity derivatives. I mean, it makes no sense. It is impossible. There is no such thing as income. Income is something that is only related to debt securities. And equities and equity derivatives are not debt related. So forget about it. And if you go to websites that try to sell you into trading butterflies as income strategies, then those guys don't know what they are talking about, and run away. I mean, just stay away from anyone that claims that you can generate income with options, and in particular income with butterflies. The reason is that I know why they say it. The reason is that butterflies get more expensive with time. So you buy a butterfly cheap, you will notice that the butterfly starts appreciating as time goes by. So there is a confusion there, people thinking that profit that you are getting because time is passing is somehow related to an income or comparable to let's say the coupon on a bond. It is not. You're basically just collecting gamma right there, and that's what you're doing, but it's very risky. Okay, so let's look finally at the profile of a butterfly. This is a chart that I just lifted from the CBOE website because they have nice charts there now for every for every option position. And this is kind of the profile of a butterfly, and that's why it is called a butterfly. I don't know who thinks that this looks like a butterfly, but apparently option traders long ago look at this and say, oh, this looks like a butterfly, and then that's why the trade is called like that. I don't think it looks like a butterfly, but if that's what you want to believe from here, be my guest. So you can see this is the area. Those are the break-even points of the butterfly that I was talking about. And this is the area where you will profit. And of course, just at the body of the butterfly, you will have the max profit. And on the, past the break-even points, you're going to lose money. But the good thing is that the loss is capped. So it's a defined risk position. So the underlying can go to zero or could fly to the moon, but you are going to have a defined loss. So that's good to have. But then, just remember, no one holds these things until expiration. No one. Not a single person. Not a single rational mind will have this expiration. So therefore, this profile, this chart is completely useless. It doesn't work like this. It will never work like this. Don't even try to design a trade based on this kind of profit and loss diagram, because it's useless. You will never see it. I mean, you will have to hold the fly until the very last second of the very last day, and no one will do that. So this is useless, but it gives you an idea of where the name comes from, and also to identify the different points, the body and the wings. Okay, so moving on, this is what a real butterfly looks like. This is the real way that it looks like. And, it could be argued that this looks more like than a butterfly than the previous diagram, sorry. Okay, so what is this? I hope you can see this graph really well here. This is a graph that shows the profit and loss of a butterfly for different levels of SPX and different times. Each color line represents a different day. For instance, this red line represents profit and loss after 1 day, and then after every 5 days, 6, 11, so forth and so on until the 36th day. So from this diagram, you can see several interesting things. Look at this. You can see that the break-even points initially are really wide on the fly. The fly has very wide break-even points, which doesn't really agrees with this. This seems to be fixed break-even points, but here in the real graph, I have break-even points that not only are moving, but are also getting tighter and tighter as time passes. As you can see how this break-even point is moving. So that's one interesting thing. Another interesting thing is that profit seems to be increasing. Look at this. The max profit seems to be $1 here, but as time passes, max profit is going and going higher, like $2, then $2.50, then like $3.50, and all the way to 18, as we saw before. I'm just simulating the first 36 days of the fly. But not only that, notice how the maximum profit, the peak for maximum profit, changes a lot. Initially, the peak is just short of 2,500, and that's kind of mind-blowing, like how this fly, which is centered in 2,550, is going to have the max profit at 2,500. In other words, if you want to really get lots of money from this fly tomorrow, SPX has to go to 2,500, which is way past everything. I mean, 2,500 is like right here, and this is in the loss area, and yet you can see that after 1 day is delivering you max profit. That's kind of incredible and mind-blowing, no? So that's correct. But notice also how as time passes, the max profit is also moving with it. So it starts near 2,500, but then let's say after 20 days is more around 2,525. And as time passes, it's getting finally closer to the 2,550. So this is something that you have to take and keep in mind when you have a butterfly, is that the profit and loss doesn't seem to be connected at all with your with your strikes. No, even break-even points are not connected at all with your strikes. For instance, you have a break-even point just close to 2,400. No, that's kind of mind-blowing that this butterfly can break even at such a low level. But you also have to be aware that those break-even points are moving and that the max peak is moving. So this is kind of unexpected. No, you will not expect this if you were like trading this butterfly naively, but it is. And this simulation, this is a very accurate simulation. This is my own simulator that I have fine-tuned for like decades. So the numerical simulation here is very accurate and I trust it a lot, and that's what it is. I mean, you will see this in real life. Just to drive the point home, I'm going to do something, an even worse example. In this case, this is a call butterfly to play the market going to 2,600. So naively, I place my body in 2,600 because I saw the chart from the CBOE and I say, oh, I'm going to get the max profit here. So naively I did that. The body also with a width of 20. And yet, just notice this. Notice the profit and loss for this butterfly. If the market tomorrow which goes to 2,600, which is not that far from where we are right now, this is the dotted line, now where we are right now. If the market moves toward 2,600, I am going to lose money. This fly loses money. I don't make money. I am losing. In fact, I am losing money for the first 10 days of the trade. 11 here, like you barely break even at the 11th day. How is this possible? I mean, this is completely contrary to my naive conception of butterflies, no? Like why they don't deliver max profit in the center? Why the break-even points change? Why they change with time? So this is something that probably some beginner option traders that want to play butterflies in XPX, I think this has burned everyone. I know like show hands who has been burned by this in XPX. I must confess at some point early on in my career, like 20 something years ago, it burned me because I thought naively it will work, but it didn't. So of course there is a mathematical reason for this, but in general, notice that in SPX butterflies, in fact on index butterflies in general, XPX, NDX, Russell 2000, IWM, all things index, the peak, the max profit tends to be to the left of the body of the fly. So if the body is 2,600, the peak will be to the left. And it's only with the passage of time, that it will move towards the center, but it will take a long time. You might look at this thing. This is the 36th day, and it's not even at 2,600 yet. So basically, it only happens at the body just the last couple of weeks or the last week of life of the butterfly, which is as I mentioned before, you don't want to hold it at that time. No, you want to be out of butterfly at that time. So from these two examples, the XPX examples, you can see interesting things. You can see first, it seems that butterflies are fantastic to play downside, because look at how the break-even point extends to the downside. I mean, this is incredible. It sells more than 100 points to the downside, and also how it hits, as time passes, it gets bigger and bigger, and it's always to the left. So yes, butterflies in XPX are really good ways of playing downside. I will come back to this later on. And as you can see in this chart, are terrible, lousy ways of playing upside. If you want to play upside in SPX, don't use butterflies, please. I mean, you'll get killed in butterflies. They are very inefficient for that. And be mindful of my words. I am being very specific here. I am mentioning that this is only for SPX. This is a behavior that you will see in XPX. And the question is why? Why we see this in XPX? So the answer is this. Let me introduce you to our friend Skew. It's so funny because I see the word used all over the place. And by the way, I stop here, and I know that I'm going a really little fast here, but please ask questions. Just type your question or your comments on the chat and I will answer. No, don't let me run away with this. If you have questions, ask them right now, because I am running a little fast here. So coming back to Skew, this is the Skew, and to introduce it, I'm going to introduce what I call the volatility smile. So this is the chart. It's not a chart of Skew, it's a chart of volatility smile. What is the volatility smile? The volatility smile is just a chart that contains the implied volatility of every option, and the x-axis is the strike of the option, and the y-axis is the implied volatility in percentage points, now 14, 16, 10, whatever. This is just a section of the volatility smile for SPX options. Now SPX have hundreds of strikes, and it extends all the way to like 100 here, and it extends all the way to almost 4,000 on the right side. But this is how the volatility smile looks for options that expire on December 29, which are the options that were used for the simulation of the butterflies that we saw. So, so you notice something very interesting. First, in a perfect universe, in a perfect world, there should not be a volatility smile. Every option on the underlying should have the same implied volatility, so you should see a horizontal line here, and that's what we had back before 1987. And before 1987, we used to have a flat volatility smile because that's how it's supposed to be. However, after the crash of 1987, people realized that the distribution of log returns in the SPX was not log normal. We have this assumption that we have a log normal distribution, some kind of Gaussian distribution, and it's not true. Of course, it's not true. I don't even know why it took so long until 1987 for people to realize that. But I know it took a lot of people to suffer major losses or go out of business for them to start pricing options more accurately. So once the new methodology of pricing options took hold, then you can see this. You can see that puts, which are to the left of this dotted line, are substantially more expensive than calls. Calls are to the right of the dotted line, and it is what it is. It's the law of the universe in SPX, no? And if you pick like a put that is, let's say, 80 points away from the money, it will cost you around 12 balls. But if you do the same thing for calls, it will only cost you like nothing, not even 5 balls, I guess, are here. So the calls are incredibly cheap compared to puts. Remember that implied volatility is a proxy for price. So, okay, so that's fine and dandy. Okay, I understand the volatility smile. What is a skew here? So a skew is the slope of the volatility smile. Very simple. So is nothing else and nothing more than the slope. Don't think that the skew is anything else. So you remember your basic algebra or your basic, I don't even know what it is, calculus or algebra. So this thing looks like a straight line, and it's so straight, and this is from real data, like real team data. I extracted this probably less than a half an hour ago. And look how nice and straight it is. If you imagine, just forget about whatever is on this side. Just imagine the left side, and imagine that this is a straight line, and this straight line has a slope. The slope of the straight line is the skew. So you can tell right here that the skew of SPX options and on December 29 is negative. Not only is negative, it's heavily negative because the slope is really high. No, so that's something with SPX, and in fact it is negative pretty much all the way until here, which is, I don't know, like 2,650. And then kind of becomes zero, no skew, and then it switches sign. But it's too late, it switches sign, and it switches sign is really small. So skew changes depending on the region where you are. But in general, the skew is very negative on the left side, and it's very negative across most of the strikes that you will trade. So now let's visualize where our example butterfly is. Our example butterfly is centered right here in 2,250. Which is on the area where the skew is negative, and that's the body. And then one wing will be here, and then the other wing will be here. So the butterfly is basically placed across this negative side of the skew, of the volatility smile, where the skew is negative. And that, ladies and gentlemen, is the reason why the butterfly behaves like it behaves. The reason that the butterfly behaves like this is because of that incredibly high negative skew, because every option on that butterfly, the options on the wings and the options on the body, have complete different implied volatilities. And the implied volatilities are so different that the dynamics, the price dynamics of each of them is incredibly different. And you can see it here in this line. It's dramatic difference, because you are here like around 10, just out of coincidence. The body has an implied volatility of 10, but then the wing is around 11 and the other wing is probably around 9. So it's a massive difference in implied volatility, and that makes the dynamics or price to be incredibly different. And you guess it, when you have negative skew, then the peak is to the left, and if you have positive skew, the peak will be to the right. And if you didn't have a skew at all, if this line were flat, then the butterfly will behave as the diagram on the CBOE. It will be perfectly always centered around the body. No, that's how it will be. So let's talk about butterflies and skew. Butterflies. So in butterflies, no one tells you this, by the way, but skew is the main driver of performance of a butterfly. Forget about implied volatility, forget about any other thing. You can think about all of the Greeks, just forget about them. The central component of a butterfly trade is a skew, period. So if you have an underlying that has a heavy negative skew, then the butterfly is already under the effects, and the effects is the max profit is to the left of the body. You know, it also, the effect also depends where you are on the curve, so you have to be aware where you are. So because of this, butterflies are perfect to play bearish plays in index options, and because of that, they are terrible ways to play bullish plays. So this is something that I have mentioned before. If you want to play downside in XPX or NDX or similar indexes, butterflies are the way to go with certain parameters that I will mention later. Don't go crazy just thinking, that, oh, let's butterfly this all the way down. No, there are certain things that you have to consider, but in general, butterflies are really good ways to play downside. And terrible. In fact, just forget about it. Don't ever use a butterfly to play upside in SPX. Don't do it. Just don't do it. At least until you become an expert on this thing, and then you can see that there are certain cases where it might work, but in general, don't do it. So now let's talk about butterfly and Vega. This is something that we cannot get away from it. A butterfly trade, whenever you open a butterfly, you are getting short Vega. There is no way around it. You are short Vega no matter where you are. And this means that any increase in implied volatility impacts negatively the trade. So if you are in a, like, volatility is low right now, for instance, right now in XPX, volatility is low. No, and we open a butterfly, a downside butterfly, and then the market falls. So implied volatility starts to go up, and it starts to impact negatively my fly. And you say, wait a second, you say that butterflies were perfect bearish trades. Now you're telling me that even if it goes down, it impacts negatively the fly? And I say, yes, sadly is the truth. However, this is how you can overcome these things. Yes, so there is no way around short Vega. However, if you really want to play it, there are ways to overcome short Vega, and one is, let's exploit a property of Vega. One of the properties that Vega has is that Vega tends to disappear, and tends to become smaller, and actually disappears the closer we got to expiration. So if you pick short dated flies, I mean, don't go crazy, don't pick flies with 1 week to go, no? But I mean short dated, like 40, 50 days or less, Vega is tolerable. I mean, changes in implied volatility will be tolerable. The impact on price won't be that big. And another thing that you want to exploit if you want to play a bearish butterfly is the amount of short Vega on your position is proportional to the width of the fly. So, I pick butterflies with 20 points width, and one of the reasons is because I don't want those butterflies to be affected by Vega that much. So, yes, you could go crazy. You could reduce the butterflies to 5 points, but I mean, doing that will reduce the area the total area of profit. But yes, a 5-point butterfly, for instance, will be almost impervious to changes in implied volatility. And the opposite is true. You have a gigantically wide butterfly, it will be very sensitive to Vega. So just keep that in mind when designing trades. Okay, and then on the other hand, sometimes that's exactly what you want. Sometimes you want to use the butterfly as a way to actually profit from that. So the implied volatility is substantially high right now, and you want to exploit the fact that it will collapse eventually. So yes, a butterfly is a good way also to play short Vega, and that's one way that most professional people uses them. They don't care about direction, they just want to extract the implied volatility. But then if you do this at SPX, then the benefits of the short Vega are negated by the fact that the SPX are terrible upside plays. And just be honest about it. The only way in the index that the implied volatility goes down is when the index goes up. No, why? I don't know why, but that's how it works. No, the people love to sell implied volatility at higher levels. So then you'll be cursed, like, man, I want to capture implied volatility, yet the butterfly will not work well in upside. But there are ways, as I say, there are ways to minimize that. For instance, Vega is very big the farther you go away. So if you go really far away, for instance 6 months or a year away, implied volatility will be gigantic. Vega will be so big that the negative dynamics of price will not do anything to them. You will benefit a lot from the collapse in Vega. And also keep the butterfly incredibly wide. I joke here and I said infinite width will be ideal. And yes, infinite width will be the perfect trade. Infinite width, by the way, for you guys that are curious enough, a butterfly with infinite width is basically an straddle. So is when one wing is like there is no wings. No, you just remove the wings of the butterfly, you are left with an straddle, and that's what you want. But I mean, I don't want an straddle because it's an unlimited risk. But yes, it's like 100 points, 200 points, or something like that. Like some gigantic width and really far away. Then you are actually playing on Vega. And if you want, you can hedge residual positive delta with really cheap near-time options. Is another way to capture Vega. I mean, those kind of butterflies, when you actually design them, you will notice that they will have very little deltas to the upside. But if you don't really care, you can hedge them. And that's how you play butterflies in XPX. Please let me know if you have some questions until here. I am about to be done, but I really want to know if you have questions. Just type them. And remember that there is a little delay between your feedback and my voice. Okay, so I come to kind of summarize these things. Butterflies are fantastic trades, and as you can see, are fantastic trades for two things: for downside and XPX, and in general, they are fantastic trades for anything that takes time because profit goes up with time, and they are fantastic trades for things that happen slowly. You don't want your thesis to develop really fast. You want your thesis to take time to develop. It's the opposite of long gamma. No, a butterfly is a short gamma position in general. So you want things, you are betting on a fall or you're betting on a move up, you want these things to happen slowly, ideally as slow as the expiration of the butterfly. But in general, before even thinking about starting a butterfly trade, you have to identify, the most important thing to do is identify what is the skew of the underlying that you're trading. Okay, luckily the skew thing is very consistent, and most of the time is constant. There could be, for instance, a market dislocation where the skew becomes crazy and things that used to have positive skew reverses and so forth and so on, but that's not the case. Most of the time skew has a very well-defined regimes, and I am going to give you the cheat sheet, as they say. Now the skew is heavily negative for XPX and other index options. So if you are planning on doing an index option trade, XPX or an XPY or ES or something like that, then you know right away off the bat that Skew is heavily negative. And because you know that the mass peak will be to the left of the body. Oh, I have a question. What are your observations on Skew on treasuries, commodities versus the indexes? That's a great question. I didn't put here anything about that, but yes. So I'm going to finish this list and I'll come back to this Skew for this. And so Skew is heavily negative for XPX, is heavily positive for VIX options and other volatility products. So volatility products is the opposite. In volatility products, you have heavy positive Skew to the right of the money, so the calls tend to be more expensive. The volatility smiles tend to be symmetrical for stocks. So in stocks, it's very symmetrical. It's like a real smile. So here is more like a frown. In stocks, you will see like a real smile, very symmetrical. And for commodities, that's a great question. And in treasuries, I don't really have hard data on treasuries. I don't know what is the Skew on treasuries. I could check it. But for commodities, I can tell you the following. For most commodities, Skew is heavily positive. In particular, agriculture commodities that are in agriculture, Skew tends to be heavily positive. And interestingly enough, crude oil used to be really positive, but now is becoming negative Skew. That's kind of an amazing thing that you will notice recently. So there could be some place, for instance, with oil, like there could be bets that Skew will revert to be positive again. But yeah, oil was one of those things that you could always count on Skew to be positive, and now when you check it, it's not that positive anymore. It's like it became symmetrical like a couple years ago, and now is tending heavily negative. The same thing with gold. Gold used to have a very heavy positive Skew, and now gold has a neutral Skew. It's more like a stock. If you look at gold, it will look very similar to a stock. It will be like a smile, and that's mind blowing. I don't know what's going on there, but that's kind of like the things that I want to comment. And this is interesting because I mentioned heavily negative Skew moves the peak profit to the left, and of course heavily positive Skew moves the peak profit to the right. But what happens when the volatility smile is symmetrical? No, that's one of those cases. What is the case when the volatility is symmetrical? And that's a really great case. If you can see that the Skew is symmetrical or very symmetrical, then butterflies are perfect. You can use butterflies for anything on those things. I mean, in this case, in options, we can only use butterflies for downside, and in volatility products or commodities like agricultural commodities, we can only use butterflies to play upside. But in stocks, we can use them for both. That's beautiful. No, in something like GDX and now gold, that is mind blowing. We could use butterflies to play upside or downside, and in fact in our gamma optimizer room we have used them successfully for that, and that's one of the reasons, because Skew has been very neutral in gold and the miners. So, and yet when you do that, you're trying to play a potential topping or bottoming region. And for those of you that belong to the ElliotWaveTrader.net room, you will notice that they have really nice targets up and down, and then you could develop a whole strategy trying to capture those targets, the blue boxes from Avi, with flies. That could be a good way to do it. In particular, if you get the timing right, it could be very profitable. And before finishing, remember, so for stocks or single names and even gold, you can develop, you can play any side. Oh, for treasuries, I don't know treasuries, but I noticed the last analysis that I did for TLT, which is kind of an indirect way of playing it. TLT tends to have a neutral Skew, tends to have a volatility smile. I don't know how close that is to like the full treasury market, but at least in TLT, I have noticed that it has a normal volatility smile. And again, to drive the point home, in indexes, please, butterflies are only good to play bearish trades and with tight flies. Don't get them really wide because you will get killed because of the Vega. You are short Vega. And here I open the room for questions and some topics I didn't touch, like broken butterflies, butterflies as limited straddles, and probably what else here? I don't know. Any questions that you have? And butterflies and gamma. I really didn't go into detail about the connection between butterflies and gamma. The only thing I want to say is don't. You don't want butterflies to have a lot of gamma on them because you will be short. So this is one of those things. That's why you want your butterflies to have some time to expiration. Remember, gamma is gigantic near expiration. Gamma is mind-blowingly high on the day of expiration. So as a rule of thumb, the last week of anything will have incredibly gamma. And butterflies, if they are if the price is near your body, is inside the butterfly, you will have huge amounts of short gamma, and you don't want to be short gamma. That's the thing. You don't want to be short gamma the last week of trading. So BXX and VIX flies. This is a question. Like, how about BXX and VIX flies? That's a great question. So BXX and VIX. So VIX is just a mirror of this. If you do for VIX, it's just imagine that you put this in a mirror and the skew is all the way to calls. So in VIX, calls are overpriced and puts are cheap, and butterflies behave exactly the opposite. So in fact, butterflies are a great way to play a bullish position VIX, and it is mind-blowing. And at the money, butterfly on VIX is a great way to play upside. So if you do like an at the money butterfly on whatever is the front month, and you will think that you are playing range bound, you are not. What you're betting is that VIX will go up, and it's a great way to play increases in VIX. Some banks use that. It's a systematic trade. When they think that VIX is undervalued, they will place like a 60-day or 90-day butterfly in VIX at the money, or just a little out of the money that will capture upside, and is gorgeous because it captures upside. VIX is better than XPX because you know that VIX is mean reverting. So you have this butterfly that will capture the move up, but also if it overshoots the fly, for instance, if it goes really, really far away, you know it will come back. It will come back to the fly eventually. So butterflies are good trades if you have good amount of time on them for VIX, and the same way for VXX. VXX inherits a little bit of the skew. It's not as pronounced as the skew in VIX, but it is there. It's also positive skew. Any other questions, folks? I guess I blew by my allotted time. I thought I could deliver this in half an hour, but hopefully you enjoyed the presentation. It's an advanced topic, and hopefully you understand why butterflies in indexes don't behave the same way that theoretically they behave, and why you should not hold them. And it gives you an idea of when to use them. No, there are other topics like I mentioned, broken butterflies. Broken butterflies are just butterflies that are not symmetrical. In this case and in this example, the wings are always at the same distance from the center. So broken butterflies can be a combination of the distance is not the same, so some wings are farther away, or you don't do the multiples. You don't do one wing and two bodies. You do like any other fraction. And butterflies as straddles is a very interesting topic because yes, and if you look at the body of a butterfly, it's an straddle. If you come here at the very beginning of the presentation, you can tell that I'm basically selling twice the body, and because of pull call parity, this is exactly the same that I sell in the straddle. So butterfly is a way to get an straddle with defined risk, and there are very interesting trades with the straddles too that at some point I will get in the YouTube video, but not today. So if there are no more questions, then that will be it, folks, and thank you again for joining me, and hopefully you had a good time. Thank you very much.